Alright everyone, Cowboy Trades here and welcome back to the channel. So there is a lot to talk about today. We're going to start off the video with a quick news rant before diving into the charts, and of course everything is timestamped below for your convenience. So quite recently the US government has just guaranteed all of the Silicon Valley Bank deposits which were trapped, and these are going to be available today on Monday, which has the markets talking about, is quantitative easing coming back? We're going to be talking about this in the video. So since this news came out, the stock market futures had a sharp rally back to the upside coming into Monday, but they have since reversed all of their gains. However, Bitcoin is absolutely soaring, up 20% in the past 3 days, having a huge divergence from the stock market. Bitcoin is soaring up and the S&P 500 is melting down. Now, the federal government and the Federal Reserve have both said that the taxpayer will not bear any costs for any losses associated with the bailout of these banks, and Wall Street will be paying directly using the Deposit Insurance Fund, which is basically a fund funded with the quarterly fees assessed on financial institutions and interest on government bonds. Now, we don't have the exact figures on how much will be needed to bail out Silicon Valley Bank, but they held around 175 billion. And if you didn't know, the Deposit Insurance Fund, which we'll just call DIF for the rest of this video for simplicity, only has around 100 billion in their account, which could imply that if taxpayers are not paying for this bailout, then they will be paying for the next one. So after this, the Treasury Department came out and said, today we are taking decisive actions to protect the US economy by strengthening public confidence in our banking system. This will help to ensure that the US banking system will continue to perform its vital roles of protecting depositors and providing access to credit for households and businesses. Now, they may as well have came out and said we're bailing out our friends and big tech companies, because if you didn't know, Silicon Valley Bank specializes in banking for tech startups. And about 85% of the money that they held was uninsured by the FDIC. And also, if you didn't know, the FDIC insures all deposits underneath 250,000, meaning that around 85% of the bailouts are happening for their friends and tech companies. With this news, the Federal Reserve announced that it is now going to be creating a new lending facility for the nation's banks to protect bank customers and prevent other small and regional banks from collapsing, which is what has a lot of people talking about quantitative easing right now, which is why Bitcoin is moving up so strongly right now. Now, to clarify, quantitative easing has not been confirmed. Basically, what happened over here is with this most recent fund that the Federal Reserve has announced, we'll read this part over here. It says, with approval of the Treasury Secretary, the Department of the Treasury will make available up to 25 billion from the Exchange Stabilization Fund as the backstop for the BTFP, which is the Federal Reserve's new banking fund. Now, the Federal Reserve does not anticipate that it will be necessary to draw on these backstop funds, but yeah, as you can see, they're not talking about quantitative easing, they're talking about getting 25 billion to fund this operation from the Exchange Stabilization Fund. So to clarify, no quantitative easing has been confirmed. However, if more banks start to go bust, this will definitely be something that we could see very, very soon. But on to my last point before we do discuss these charts. A lot of people who are not well versed in the 2008 global financial crisis may be thinking, hey, banks go bust, money printer go burr again, quantitative easing starting again, you know, this is going to be bullish. But this could not be further from reality, because in 2008, bank bailouts by the taxpayer with quantitative easing were estimated to be between 200 and 500 billion. And this widespread bank failure followed by bailouts with quantitative easing was not bullish for the markets. Which brings us on to our TA segment. I want to show you what happened. So right now, you know, people are looking at a small 25 billion, which by the way is not going to be backed up with quantitative easing. We just talked about where they're going to get that money from. But in 2008, once again, let's go with the low estimate that 200 billion was used with quantitative easing to back out these major banks. Now, you can actually scroll through and look at this entire list. I will leave the link to this down below. As you get past November, you start seeing just bailouts in terms of the millions. However, the top banks that were bailed out in October and November, and you can see these huge huge amounts, summing up billions of dollars which were paid by the taxpayer with quantitative easing. So in October and November, most of these major banks were bailed out. And when we do come over to what happened in the 2008 financial crisis, of course, cryptocurrency was not trading back here. I mentioned that because my channel is really a cryptocurrency focused channel, although we do focus on the stock market a lot as well. We do both on this channel. However, back to the point, if cryptocurrency was back out in this region, a lot of people in the markets would be saying, hey, you know, quantitative easing is coming back. Look at how much money is being printed. 25 billion for this bank, 2 billion for this bank, 15 billion for this one, 25 billion, 25 billion, 10 billion, 10 billion, 3 billion, 3.5 billion. You know, money printer go burr. The markets are ready to pivot. However, what actually happened? Massive confidence was lost in the banking sector. Quantitative easing shot up, inflation shot up, the markets absolutely melted. And you can see here, October of 2008 leading into December of 2008. So we're looking at the start of October really till the end of November over here. You can see the markets absolutely melted. They went down 30%, and after these major bank bailouts happened, you can see they were down about 20% coming into the month of December. We had a sizable rally, and this is kind of what we potentially might be seeing a little bit of right now. Once again, my channel mainly focuses on Bitcoin. You can see Bitcoin is up 20% in the past few days. The futures market did have a rally into Monday, but now we are losing confidence and breaking back down to the downside ahead of tomorrow's CPI report. But with that being said, you can see the S&P 500 proceeded to have a 26% rally from its lows. I wasn't really trading the markets back in 2008. I definitely wasn't a trader back here. But I can imagine a lot of people were bullish back here, thinking the markets are ready to resume to the upside now that quantitative easing is back. But they continue to melt down into new bear market lows coming into 2009, down another 29%. And from when quantitative easing started, they broke down another 39%. So if you can imagine the stock market breaking down 39%, you can imagine how much your cryptocurrency markets, your Bitcoin, and especially your altcoins will melt to the downside. So I just want to highlight here, a lot of people, once again, are going to be thinking that if tons of banks start going bankrupt and quantitative easing resumes, that is going to be bullish for the markets. Historically, this has not been bullish for the markets. Huge banks going bust, followed by quantitative easing paid by the taxpayer, absolutely destroys confidence in the markets, and it increases inflation. The average US American, you know, plunging into these recession territories with banks failing is not bullish for the markets, people. It does not matter if the money printer turns back on. If all of these banks are going bust, we are going to feel the pain of these markets. So once again, just wanted to highlight, in previous examples coming into the 2008 financial crisis, when these big banks were bailed out using quantitative easing, that marked the final capitulation and an absolute meltdown extravaganza. You can see, obviously, from 2007 coming into 2008, yes, this bear market was bad, but it really started to pick up when these bank bailouts started to come into fruition. So we've gone on a very, very lengthy news rant. We've talked about what happened in the year of 2008. We've talked about quantitative easing. We've talked about the Fed's new fund. We talked about the sharp rally that happened in the S&P 500, proceeded with the breakdown. We talked about the DIF, which will be, directly bailing out SVB, and how the US government has guaranteed all of the deposits, which has led the markets to have a slight bit of confidence back in, and especially in the cryptocurrency markets, which are rallying. However, I have just made a new Bitcoin specific video, so if you do just want my Bitcoin TA, feel free to check out that previous video. As we've done a Bitcoin TA video, let's now dive into what is happening in the S&P 500. Let's talk about the TA that is happening right now. So recently on the channel, we obviously discussed how the insider transaction ratio was skyrocketing, meaning that insiders in the stock market were selling their own stocks. Now, after this had a huge spike, you can see these three major spikes in terms of insiders selling. You can see these spikes were marked by huge tops in the market. Each of these breakdowns led by a rally and then a new low. This rally over here was a breakdown, rally into a new low. Quite recently, if we come over to the daily time frame, you can see corporate insiders started selling round about here, pretty much the top. We broke down, had a rally, and we are melting to the downside. Even though your cryptocurrency markets are up, the stock market has been plunging for the past few trading days. Unlike Bitcoin, which is still rallying, the S&P 500 is getting absolutely obliterated right now, and we are having a slight pump back. As you can see, in the past 3 or 4 hours we're having a buyback, but if we come over to the daily time frame, you can see that we absolutely fell into the abyss, and literally from Wednesday we are down about 2.7%, and we dropped almost 5%, down 4.65%. So the markets are not looking bullish whatsoever. Insiders are selling. Markets are absolutely melting and getting obliterated right now. If we do come over to our Elliott wave count, you can see that once again, we've talked about this many times, we had a 5-wave bearish count into an asymmetrical triangle. This is typically a continuation pattern depending on the direction of the trend that you break into. So you've got a bearish 5-wave into an asymmetrical triangle. We had this throw over. You can see from this trend line, we had a trend line here and an upwards slanting trend line right here. We really back tested both of these, and now we're getting absolutely obliterated to the downside. We do have a price target of this, which we will talk about in this chart over here. Also, you can see the macro bear market trend line from here, touch point here, touch point here, touch point here, touch point here. We had a throw over, and we've broken to the downside of this. Now, since the most recent rally off the lows on the 10th of October, you can see from the low to the high, drawing off Fibonacci, we've quite recently bounced on this 0.5 Fibonacci. And of course, we did open significantly lower. So if you are coming over to some SPX charts, some of these are in the green today, but bear in mind the futures market absolutely melted and then proceeded to have a bounce, and this is why the SPX is kind of just covering back what happened over on the futures market. But in general, you know, from where we were over on Friday, we are still bleeding out for this market, having a slight bounce on the 0.5 Fibonacci. Potentially, I do believe it is possible we could go as high as 3,930, although I wouldn't be counting on it. I think we're pretty much topped out. Whether we top out here at 3,906, which we've already started to come down from, or whether we push up another 20 points or so, coming up to 3,926, 3,930 before melting down, it really doesn't matter. We are right at this next top region, in my opinion. I do believe we're going to be heading down to the 618 Fibonacci next at 3,760 from where we are right now. This would imply about another 3.3% move to the downside. And of course, we do have this beautiful price gap all the way down here. You can see we closed over on Friday all the way down at 3,583. This is a close on October, by the way. And then you can see coming into the next week in October, we opened all the way up here, never revised this price level. So we do have a beautiful gap to fill all the way down at 3,584, which is not a price target for today or tomorrow or this week. I think we're coming down to 3,758 first. But after then, I see us plunging about another 7.6%, coming right back down to the bear market lows. We do not have much room to the downside after then, before we do, of course, plunge into new bear market lows for the S&P 500. And looking at all of these charts that we've just discussed, it is not looking good for the markets, especially if we start to see more banks going bust. Quantitative easing resumes, and it is not going to be bullish for the markets, contrary to what a lot of people believe. Of course, quantitative easing in the right market scenarios is absolutely bullish. Quantitative easing in a recession when banks are going bust is not bullish whatsoever. It also seems like Michael Burry thinks that quantitative easing might be coming back. Now, this guy kind of speaks in codes and he deletes all of his tweets after he posts them, so it's a little bit hard to decipher exactly how he feels. But what he said is pretty black and white. He said the year 2000, obviously 2000, 2008 recession, and 2023, it is always the same. People full of hubris and greed take stupid risks and fail. Then money is printed because it works so well. So in my opinion, it kind of seems like Michael Burry, which, like I said, has since deleted this tweet. You can find this over on Michael Burry's archive. But it seems like he is also believing that quantitative easing might be coming back. And of course, him referencing the years 2000 and year 2008, like we have discussed in this chart over here, looking at the data, contrary to popular belief, breaking into recession, having bank runs, followed by bank insolvencies, followed by bank crashes, banks just going bust left, right, center, backed up by quantitative easing to bail them out with huge money from the taxpayer is not bullish for the markets whatsoever. Now, I just want to finish this this video off with a quick look into some other metrics. Now, government bonds and the DXY are having a significant pullback at this moment in time. So a lot of the markets are in disagreement right now. The bond market has been on a super strong rally quite recently, but with this talk about quantitative easing returning, the banks going bust, a lot of people have this notion and are thinking right now that the Fed might have to pivot and they might have to start printing money. They might have to stop raising the interest rates. Otherwise, lots of banks will go bust. And if lots of banks go bust, they'll have to resume even more quantitative easing, which might be even more bearish for the markets. Now, we don't have our next FOMC meeting for 9 days, but we do have CPI coming out tomorrow. So I will keep you up to date on how all of these stock market things play out. If the Fed make any commentary, you will find it over on my Twitter at 618_cowboy. So if anything of importance happens, be sure to follow me over on Twitter at 618_cowboy, and I will keep you up to date with these. But just to let you know, bond market still at a very healthy level of resistance. 2-year bonds sitting above the bull market support. 10-year government bonds sitting right on that bull market support, or bull flag support rather. So I still do believe these have more room to push up in this cycle. Of course, as we discussed, the equity markets are nuking. NASDAQ kind of just bleeding out sideways a little bit. SPY, SPX, potato, QQQ, NASDAQ, once again, potato. The Dow Jones has gapped lower this week, and it looks like it's got a massive bark pattern, and it is absolutely melting through the floorboards right now. Like we discussed, DXY is actually rejected from this trend line, but as I have been talking about on the channel, I much prefer to keep my eyes on government bonds. When everyone is raising their interest rates, it makes it harder for the US dollar, specifically the DXY, to have much growth. So with that being said, I've got my eyes on government bonds. I'll keep you up to date with how these work. Also, if we move on to the Fed futures, these have started to melt to the downside. Now, a lot of people, you can see the last time I covered these were at 5.5%, and they have melted through the floorboards. Now, people are starting to expect rate cuts. Previously, right now, the interest rates are at 4.75%, and now Fed futures are coming down to 4.1%, meaning that the markets are expecting that Fed are going to start cutting the interest rates, and we're going to move down to a terminal rate of 4.1 instead of 4.7. I personally don't think this is going to happen. I think at best, Fed will pause their interest rate hikes for a while it's not what I'm predicting. I think we get 25 basis points, of course. We'll find out that in the next 9 days or so, but the markets are moving absolutely nuts right now. The S&P 500 is breaking down. Bitcoin is pushing up super strong, having a divergence. We're seeing Fed futures break down while the markets start to price in that the Fed are going to be lowering the interest rates and stopping raising the interest rates. But the VIX, your volatility metrics are skyrocketing. In the past 3 trading days, they're up 37%. Today alone, the VIX has skyrocketed almost 11%, and earlier today it was up almost 28%. So someone's lying here. One of these charts is lying. You've got Fed futures breaking down, but you've got the VIX breaking up. You've got the S&P 500 melting right now, absolutely melting through the floorboards in the past few trading days, absolutely melting. But you've got Bitcoin breaking to the upside. We're seeing so many divergences in these charts. The VIX is up, the VVIX is up. You've got implied volatility, had a huge skyrocket earlier, kind of just sitting at the opening right now. We'll keep you up to date with this, but a lot of these charts are in disagreement. You know my thoughts on these markets. I will keep you up to date, of course, but for today, my friends, that is all I've got. I gave you my price targets for the S&P 500. We've dived through the news. That's really all I want to discuss today. Definitely a video much longer than my normal content, but like I said, there was so much to dive into today. The markets are moving absolutely schizophrenic. There are tons of divergences happening right now. We've discussed all of this, so I'll wrap up the video now. That's all I've got for you today, my friends. As always, if you do enjoy my content, let me know down below by leaving a like and a comment. Share the videos with your friends. Keep up to date with my thoughts on the market. If you want extra content, follow me over on Twitter at 618_cowboy. Also, be sure to come and join the Discord. If you head over to my YouTube, click on the About section. You can see my links for Twitter, Discord, Instagram, and the merch store are down below. Also, bear in mind, I will always keep all of my content on YouTube free forever. I never want to charge anyone anything extra for any extra content I provide. But if you do want to support the channel, feel free to check out the join button and become a member. For today, that's all I've got. It has been your boy Cowboy Trades. I'm out, my friends. Peace.